So get this. Earlier this morning, I'm reading two different pieces of research in a row. An excellent piece, a thesis even, on Dollar Tree by Matt Boss from J.P. Morgan. He's the best retail analyst in the business right now. Followed by a well-reasoned tome about how Darden, parent of Olive Garden and, yes, Longhorn Steak, has the scale and management to dominate what I call the slow casual dining category. I call it that because how else could you do it? I mean, given the line at Olive Garden, it's always so jammed when I go. Now, I like both these pieces. Dollar Tree, like its cousin Dollar General, far less China exposure than most people seem to understand. Everybody's worried about what happens to the dollar stores when Trump's new tariffs go into effect September 1st. I think it's going to be very manageable. How about Darden? On the surface, the company's got plenty of woes, from the cost of their never-ending dishes to the labor shortages to rising price of chicken or beef. But right now, everybody's worried about a slowdown. And if we have a slowdown, the labor shortage will be no longer a problem. Oh, and if China really wrecks American agriculture, that's a blessing for the restaurants because it means the raw costs will come down. Meanwhile, the price of gasoline is going to plummet, leaving consumers with more money in their pockets. That always means they go to Olive Garden. As for Dollar Tree, hey, that's where you shop when the economy's in trouble. Everybody knows that. Then after I read the notes, very upbeat, I go watch the news, and it's like a litany of woe. I mentioned it at the top of the show. The Chinese army looks like it's on the verge of occupying Hong Kong. There are trillions of dollars of negative yields. Europe seems like I head back down to a recession. Meanwhile, our trade war with China just keeps escalating. So what do you do with the likes of Dollar Tree and Darden? Don't kid yourself. These are great companies, but their stocks are members of what's called the S&P 500. So you have to worry that they could be dragged down by the gravitational pull of the entire market. Even with these fabulous pieces of research this morning, well, Darden shed more than a percent. Now, Dollar Tree actually managed to rally. I think that's Matt Boss's work, so he kept it. He's that popular. At the same time, I can't get it out of my head that a slowdown will draw people to Dollar Tree like a magnet. And the new, cleaner stores have never looked better. Great brands, too. Years ago, they bought Family Dollar, a much worse chain. But they keep revamping those stores with terrific results. If you get a dip here, well, you know what? I think to buy. Darden, stock yields almost 3%. Dividends is about as safe as it can get. Darden sells for less than 19 times this year's earnings. Dollar Tree clocks in at 18 times. I think the future for both companies seems brighter than the past. Yield, inexpensive versus its growth rate. What is not to like? It's their membership in the S&P 500, though, that worries me. People sell the S&P 500 in this kind of market. I could see Darden falling to 17 times earnings, Dollar Tree going to 15 times earnings if the averages keep getting hammered based on these overblown fears of recession. Those would be big hits to these stocks. Fear can do that. I saw it happen in 1998, the fear of the system collapsing. Of course, back then you had a catalyst, the collapse of a big hedge fund long-term capital, and you had no idea how low things could go until the Fed cut rates at an emergency meeting. But we didn't know about long-term capital until it happened. Maybe that's happening now. So you know what? Don't be a hero. I do like the stocks of Dollar Tree and Darden. I think they're owning once the coast is clear. But why take the risk now? Sure, the biggest worry right now is that the U.S. Treasury yields will keep falling. That only makes a dividend stock like Darden more attractive. And as a trade-down retailer, Dollar Tree benefits from a slowdown. But it's not enough to offset the risk for me. So you got to wait till the dust settles before committing any new money. Now, we were still selling this morning for ActionAlertsPlus.com Club. Still this morning. I don't want to be a hero. As long as the market's fortunes are handcuffed to the 10-year, so when yields go down, which they are, all stocks, even good ones, go down, like Dollar Tree and Darden, well, let's just say we're not done. Let's be careful. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.